Thanks for coming to see us today. So I'd like to introduce Christophe de la Celle. Christophe, you can give a few words about you and what you're doing.
Sure. So my name is Christophe de la Celle. I'm the Managing Director UK at HedgeGuard. We are a fintech company that works closely with crypto hedge funds on portfolio management and different operational solutions.
We have Dave Abner. Dave, do you want to introduce yourself?
Sure. Hi, everyone. My name is Dave Abner. I'm an advisor in the ETF and digital space. So one of the things I do is I work as an advisor to WisdomTree on their digital strategy. And on the back of that, one of the things we recently did was launch a Bitcoin ETP in the sub 100 basis point range, which we'll talk about. And we've done some work on tokenization and investments in tokenization in the US and the Middle East.
And we have James Brodie from ID Theory. So James, do you want to give a few words about yourself?
Thanks, Christophe. James Brodie, I'm the co-founder and chief investment officer at ID Theory. ID stands for Incentive Design. We invest in crypto assets only, secondary markets, so no VC or equity, and we're a predominantly long fundamental fund.
Thanks very much. So we are going to talk about what is happening these days when we see the market vacillate quite a lot, and we had the Bitcoin trading quite a range over the past year, about $7,000 to $10,000. And one of the questions I have for James is basically, how can managers use this volatility to their advantage?
So, as I've said, we're a long fundamental fund, so I might allow some of the other panelists here to talk about some of the other strategies that might be employed by hedge funds, whether that's working on the futures or other derivatives. We really use our history and experience to help our investment management decisions. So I personally have been investing in the space since about 2013. And when we set up the fund, the intent was to provide our investors with exposure to those decentralized networks via investing in crypto assets that we thought would have longevity, high upside, and really make a difference in the world. So the space is very fragmented, and one of the strategies we employ is to spread orders, laddered orders across exchanges. I think what we see a lot is kind of liquidity issues, and you get these crazy spike downs. So by positioning orders over various exchanges, you remove the counterparty risk of having all your money at one place, but you also can benefit from catching these market events. I think you're, Christophe, probably a bit better to talk to some of the more traditional ways of benefiting from volatility in this space.
Sure. It's really interesting what we're seeing in the crypto space. It's as you know, the market matures very quickly. One day in crypto is 6 months in the traditional world. So we've seen options now that have developed quite nicely. We have, I'd say, semi-structured products, so very light structures that are being rolled out to cater to minor demands. But also, the funds that we work with are more and more sophisticated in terms of strategies. So they're putting on option strategies either to go long volatility, but when you think about it, in crypto, you're essentially trading volatility of volatility. But you can also put in place option strategies to capture range-bound markets as well, like butterfly spreads, etc. So there's a lot of flexibility that is offered by what we're seeing as the early days of crypto derivatives. I also heard recently that you can trade variance swaps on Bitcoin. So it's great what we're seeing, and it gives more options to fund managers.
So if we carry on in that direction, basically we've seen an intensification of the correlation between the largest coins. Now, how can a manager ensure there is some diversification in their portfolio if all the coins seem to be moving up and down at the same time?
When you look at the research, the correlation is really most prevalent at the larger market cap cryptos. So again, speaking from what we do and our strategy, We have three investment areas, three themes that we invest into. Obviously, the kind of first killer use case of this decentralized technology was money. So what we invest in predominantly in that area is Bitcoin, but then some smaller cap projects that we think offer things above and beyond Bitcoin. So Bitcoin's brilliant at doing a number of things. It's bad at doing privacy. So we're very interested in investing in privacy tokens, and we'll look at some of the smaller cap ones to kind of furnish our portfolio there.
Sorry,
Yeah,
I was going to ask you a question.
of course.
Is there enough size in those for you to get beyond 10% of your portfolio?
For us, yeah. So fortunately, we're a smaller fund. We've never faced any liquidity issues being able to allocate the position sizes that we want to. We've got quite a long tail, actually, because of that issue around trying to find anti-correlative assets. I think another area is probably benefiting from assets in the space that themselves benefit from volatility. So centralized exchange tokens is one area that you could find, and I know that Binance was one of the least, or BNB was one of the least correlated coins last year. I think another example is in our second theme, it's network access, but that primarily means smart contract platforms. We'll invest in an asset, so we like Ethereum, but then we'll look at projects that do things that aren't better than Ethereum, so not like these projects that have tried to address the scalability issues, but are answers to some of the issues that Ethereum has faced from perhaps like a governance perspective. So putting it next to Tezos in the portfolio, and Tezos was one of the least correlated assets within the whole class over the last year. I think it just really comes down to portfolio construction, to be willing to have a kind of diverse collection of different tokens that all fit the market within which you're trying to invest.
Thanks, James. So, Christophe, with your function at HedgeGuard, you meet a lot of startup managers. How do you think they have been impacted by the crypto winter we've had last year?
Well, I think crypto winter was
From 2018.
Yeah, from 2018 was a pretty painful moment for a lot of us in the industry, but there's definitely a silver lining attached to it in the sense that the space has become much more institutional. So the projects that we work with today are now people who come from the buy side, come from hedge funds, come from banks. They're either partnering with somebody who has crypto knowledge or going at it on their own because they see the price action, they see the volatility. There's definitely some alpha to capture in the crypto space. So the way it's evolved is that we've seen it's essentially evolved on the strategy side. We started off with funds that were providing Delta 1 exposure to Bitcoin, charging 2 and 20. That's over. I mean, Dave, you can say a little bit more about the ETP type product, which is similar exposure for a cost-efficient at a cost-efficient price. We had crypto funds that were behaving like VCs, but had a total mismatch in terms of liquidity provisions. The intermarket arbitrage, the juice is sort of dried up there. But we're seeing much more sophisticated strategies come to the space now. I mentioned earlier that funds are using options quite a bit in crypto. Basis trading, triangular arbitrage, loans. I mean, I'd say the sophistication of strategies has increased quite a bit since crypto winter.
Thanks, Christophe. So, Dave, you have a very strong experience in exchange-traded products. And it'd be great if you gave us a few words about them and how they could help an investor, and also can they be useful for a fund manager?
So definitely can be useful for fund managers and investors of all kinds. So what I think is this, right? The ETP market acts as the bridge to a lot of different asset classes for investors, right? So in the early days, investors had difficulties buying emerging market stocks, and they started using ETPs to buy emerging markets, right? With digital currencies or digital assets, they think of, they're still a very small sleeve of an investor's portfolio. They probably would fit somewhere within the alts bucket. They're used as a volatility play more than anything else, like Christophe was saying. and it's still a small sleeve, right? But the ETF or the ETP acts as a transference mechanism for the industry, right? So first of all, ETFs centralize liquidity. So if we talk about a fractured market, investors don't want to navigate multiple exchanges and different ways to buy and sell things, right? They want to use one product. And with an ETF, you'll see as they continue to grow, even in this space, they centralize liquidity. They bring in institutions, retail, and all level of investors in that spectrum into one product, and the liquidity becomes centralized, and it therefore grows. They also act as the gateway, right? Like portfolio managers want to use this space, but they don't want to build an entirely new infrastructure to manage assets within it, right? So the ETF acts as a transference mechanism that sits within an institutional portfolio manager's infrastructure, and they can therefore access these tools, and then they fit within their risk metrics, and they fit within their TCA, mechanisms and things like that.
That's great. Thank you very much. So we're hearing a lot about tokenization, and what kind of development can we expect in that area, and can that become of benefit for a portfolio manager to try to get more diversification in their portfolio?
So I have a view on this, if I could jump in. I actually think tokenization is going to be bad for portfolio managers, and I'm going to explain why. I think that already in the world today, it's incredibly difficult for most portfolio managers to understand the realm of investments that are available to them and pick accordingly and develop appropriate portfolios that actually add alpha, which is why you see active portfolio management underperforming beta over time, right? Now, if you take tokenization and we increase the amount of available assets that a portfolio manager can invest in by 10x, because we've now, fractionalized real estate and created, shares of art or whatever else we've tokenized, the numbers become too big for actual portfolio managers to be able to handle the actual role of managing a portfolio. So what happens? You need to then use systems. AI becomes the dominant portfolio manager for the entirety of portfolio management, for the entirety of finance, right? So I actually think everything becomes run by this sort of systematic, or what I call an AI portfolio manager. They become the smartest and the best allocators of assets across the system.
But what do you think about, let's say, a fund manager who has a certain specialization? So somebody who today is managing a real estate fund.
I think he needs to start looking for a job.
Well, he's managing a real estate fund, but he can then access additional opportunities in the real estate space through tokenized assets.
I understand. He's going to be able to do that, but the sheer volume of choices available to him is too much for the human mind. So yeah, he can be the controller of the system, but the system will make the choices. And therefore, the problem with that is he becomes less valuable every single day.
Well, that can apply to several industries, though.
Absolutely.
Yeah.
So Christophe, you've been a portfolio manager in the traditional world before, and you might be replaced by an AI machine at some point. But
that's why I moved to fintech.
He moved to fintech. So now when you talk to a lot of these portfolio managers in the digital world, do you see them going back to traditional way of managing a portfolio and try to deploy these techniques on Bitcoin, ETH, and other digital assets?
Yeah, definitely. I mean, it touched upon what I was saying earlier. A lot of these managers are replicating what they've done in the traditional space. I know a manager, for example, he runs a quantitative strategy, very successful quant in the equity space, but he could see the volatility in Bitcoin. And he's not a Bitcoin evangelist. I'm not sure he really understands what blockchain is about, but he can see the price action. He's replicating that same quant strategy very successfully. So they're definitely replicating similar strategies and techniques that they've learned from the traditional space in the digital realm.
Just to add to the, I know we've moved on, but the tokenization point, I think given the programmatic nature of these assets, we're starting to see some interesting kind of financial instruments that from my perspective as a crypto native fund manager, are really useful. So, one of the things I said earlier on was a recognition of counterparty risk and having assets on exchange. And if we wanted to go short on one of our holdings that were larger, that would mean having to send our assets to an exchange and sell them and then have the cash sitting there. And of course, you're risking the whole time that your cash is sat on an exchange. Of course, you can take it off and on, or you could move it into a stable coin or whatnot. I think the fact that you can now have a tokenized short Ethereum token is very handy. As we're moving in, these are effectively self-custody assets. We can therefore remove that counterparty risk, take a short position with these tokenized assets, and not have the risk that we would ordinarily have if we were relying on the centralized exchanges.
I think tokenization, can I add one more piece on this tokenization piece? I think tokenization is really an infrastructure play, okay? We've gone over the last, pick a number of years. We moved from when, a world where investors bought stocks and they received in the mail a certificate, right? And then we moved to, electronic replication of your positions, right? And tokenization is, in my mind, the next stage of the infrastructure to facilitate, lower fees on transfer agency, quicker settlement, easier transfer and knowledge of ownership and things like that. So like the Big Panda guys were saying before that investors don't really care about this stuff at all. I kind of agree with them in that part. The tokenization aspect is the machine behind the machine, right? And the investor won't know the difference when we move from a world of securities like we know them today to digital securities. It won't impact investors, except for the fact that they'll see much greater breadth of product available and much, much lower fees, right? So we're already in the, I come from the ETF world. ETF fees are already down at close to zero, if not at zero in certain ways, right? So the only way to facilitate asset management products at fees of 0 to 100 basis points or less, you need to lower the infrastructure costs, and that's what tokenization does.
So I'm asking all the panelists, if you were going to look forward, what kind of tools are we going to likely going to see to help with volatility management? Maybe Christophe, you can start.
I can talk about HedgeGuard. I mean,
yeah.
So I mean, joke aside, raising if you're a fund manager or a crypto fund manager, raising AUM is hard work. We were just talking about it earlier. I mean, the hit ratio on investor meetings is probably 2 to 3%. You do 100 meetings, you raise 3 tickets. Okay, so that's the reality on average. So what you want to do is to put all the edges on your side. Unfortunately, in the hedge fund space, investor mentality has changed quite a bit since 2008. When an allocator meets with a fund, instead of thinking, okay, well, how are these guys going to make me money? The first step is, well, how are these guys not going to lose my allocation? Okay, and that's traditional or crypto. And then I think that a lot of managers in the crypto or digital asset space, they underestimate the educational journey that they need to take investors on. Okay, because it's already hard in the traditional space when you're trying to explain your strategy, what's your edge, etc. Well, you also have to explain how crypto works and what are the risks, what are the advantages, etc. And so and so. So coming back to your question, I mean, you have to, as a manager, you have to ensure that your setup is top-notch, be it custody, portfolio management, exchange, counterparty risk. You really have to make sure that every box is ticked to not give the investor reasons not to invest.
James, Dev?
Well, again, from the crypto asset perspective, we're seeing, interesting developments there. You can have stable coins that generate a yield of 8% a year. So DAI, for example, I think that's a nice tool for a manager to be able to move into and still generate a return for their investors. Again, and it's happening in the DeFi space, we're seeing products, fixed income products, for example, by protocols such as Structured. There are other protocols such as Celle that can create trading strategies. So, these are almost crowdsourced trading strategies, but might want to combat, volatility or benefit from volatility. I actually haven't seen any volatility sets yet, but I've no doubt those will emerge. There's an appetite for them. I think the other interesting thing, again, crypto asset-wise, is these stakeable assets. So you can generate yields which you can then sell if you want to. I recognize that in a hyper volatile situation, if the asset's kind of moving 30, 40% and your yield 7%, then that doesn't really matter anymore. You're still victim to that volatility. But these are kind of generators of alpha that are not ordinary and that are crypto specific.
So Dave, you were an expert in ETF, and so I'm sure you heard about all the volatility ETF and the VIX and all this type of instruments. Are we likely to be able to see something like this in the crypto world?
Are we likely to see something like this in the crypto world?
See a VIX equivalent ETF, but for digital assets?
Look, I think you'll see a lot of these tools being made, but I think more importantly, it's going to go the other way, right? So, again, I think it's about the law of large numbers, right? The large numbers reside on the institutional and the retail space. Right now, I think the crypto industry, what's a way to think about it? So I think about it maybe like you can almost, think about it like coronavirus, right? Coronavirus existed in the animal world for many years and nobody gave a crap about it. And then it moved over to humans, right? And now the entire world is panicked about it, right? If you think about digital in the same realm, I've been talking at these conferences for 2 years. And a lot of the times we're talking to ourselves and we need to educate investors and bring them into this world, right? And then everybody will care. Assets will move. Products, volatility will be created, things will trade, right? This is why I focus actually on ETFs, right? Because I know the education process very well about educating investors, and I've spent 20 years educating investors on ETFs, and today we're still educating investors on ETFs, right? At $6 trillion globally. So if we're all in this room willing to spend the next 20 years educating people about digital assets, we have a long road ahead and we have to do that, right? In my mind, the other way to do that, the way to move money more quickly is to go the other way and start wrapping digital assets in things like ETPs, educate investors that way, right? So I was just in the US, I spoke to the TD Advisor conference, right? They have a summit for investors. So I spoke to 500 advisors about how to use Bitcoin ETPs to get into this space, right? And I'm educating them on what the space is and how to get in within their infrastructure. I think that's the way we're going to go in terms of these things. And then there'll be, as assets start to really flow, we'll start to see some additional products around volatility and other mechanisms.
So, Christophe, again, you told all these new managers, how do these added volatility level in the market are adding challenges to starting up a new fund and launching new strategies in the market?
Yeah, I don't necessarily think it's a challenge, actually. I think it's an opportunity. Again, the volatility that we're seeing in crypto is attracting experienced managers to the space. But I think what digital asset managers need to keep in mind is that, well, one, as I said, allocators, the first step is pretty cautious. They're trying to understand how a manager's not going to lose their money. So if a crypto fund manager has 140% returns, well, the natural reaction is, well, you can make 140%, but you can also lose 100% of my cash. So that's one thing to think about. But yeah, as I said, I think it's more of an opportunity rather than a challenge, the fact that there's alpha to be made in volatile markets. But you have to bear in mind that now some of the initial crypto opportunities have sort of dried out in terms of trading. So you're essentially up against a long-short equity manager who has a very experienced team. He has all the infrastructure that's required. He can also produce 25% annualized returns. You have to be realistic of who you're speaking to and who you're up against in terms of raising AUM.
So James, when you talk to some potential investors for your funds, how do you introduce the potential volatility of the returns?
Yeah. Well, it's actually to kind of expand on your previous point, but answer that question simultaneously. I think, like with every market, you need to have a recognition of the cyclical nature of this market. And you've got the macro cycles, but within that you've got the micro cycles. And by that, I mean the macro cycle, which, and this is a thesis I subscribe to, but I know it's controversial, but I think is predicated very much around the Bitcoin halvening. I think within those macro cycles and micro cycles that are dependent upon kind of, Bitcoin dominance, so how much of the market is, or the total market cap of the space is in Bitcoin and how much is in the rest of the coins. There's no doubt that the last 2 years has been very successful for the volatility traders, especially in a bear market. I think when you look at the work that's done by Vision Hill, they're a fund of funds and they benchmark all of the different crypto funds. Without a doubt, the best performers have been the quants, and the market makers. I think where we've reached now in terms of the macro cycle is we might return back to a long strategy, maybe generating outsized returns compared to the volatility hunters. But I would say that because I'm a long fund. So we inform our investors as to where we think we are in the cycle. We move our portfolio around within the micro cycle, so between Bitcoin and the alts, and rebalance. We started moving out of Bitcoin back in September, and we'll be moving back into Bitcoin post-halvening.
So we have a few questions from the audience. So if we go to the one about do we believe that BTC is really safe haven like gold and Swiss franc? So we would like to jump on that one.
Do you want to do that?
Sure. No.
So do you believe that BTC...
Look, there's a lot of people that look at it like different, and they have different views on it, right? I don't see it as digital gold, which is the way it's sold. I see it as an alternative mechanism for trading, right? And it sits within your alts basket. So it's not that. No.
Christophe, do you have any view on gold and BTC?
Yeah, I'd agree with Dave. I mean, no, for the moment. At least it should be behaving like a safe haven, and all the ingredients are there for it to do so. But so far, the price action hasn't validated that. So
yeah, James.
It was set up in response to fiscal irresponsibility, and I think we're probably having what could be a very bullish setup for investing into this token. Whether it's a safe haven, I don't think it is yet, but I think it has the potential to be one when people recognize kind of what's going on in the world, and everything that's happening now, to me, is hyper bullish for Bitcoin. Maybe not in the near term, but in the medium term and long term, I think people will be using it as a haven to store their value.
See, I don't think things evolve into becoming safe havens. I think they just either are or they're not. And so there's a friendly disagreement, right? I think there's a lot of Bitcoin holders in the world who are saying, yes, we are going through some recent spates of volatility, but as the world gets to know us, we will become a safe haven. And I just don't think that's the way they happen, right? Like everybody agrees on safe havens in my mind from the beginning, and they have that stability from day one, not from day 1,000 or day 10,000 or whenever that happens.
So next one. So it's a bit of a technical one, but why is the focus on cash-settled futures and not physical deliveries, like most futures in the traditional space? So, Christophe, you are looking at a lot of technical things, so and you worked in the traditional space too.
I'm not sure. I mean, apparently the question relates to FTX. It might be a marketing angle to differentiate themselves. I mean, we used to trade a lot of commodity futures. I can tell you that we never took delivery of oil barrels. So, but in our space, in the crypto space, potentially people want to take delivery of Bitcoin or cash. I guess it gives them a bit of optionality.
Yeah, no, I've traded myself a lot of traditional futures, and always avoided taking delivery. You always roll your position in advance, and in effect, you treat them as more or less cash settlement. So I don't know if that has something for you, Dev, and into the ETF construction, but...
I had trouble hearing you a little bit, but everything we do on the ETF side is going to be physical in that sense, and that's what we believe, because people want access, tracking, right? They want perfect tracking. You're going to lose that on the future side. So the ETPs that we've been building are all going to be based around physical.
So now we have
the last
entrance of prime brokers. Do you think that will help the entry of institutional money in the space?
Yeah, I think it's a big plus. I mean, we're working on technology that goes in a direction. The big quant guys are here today. They've just launched their prime brokerage offering. I mean, I think that all contributes to making the space more institutional. Having a one-stop shop with different services is a big positive for crypto funds.
So James, do you use a prime broker for your own fund, or?
We do. We don't use them very much. We use Tagomi. Have they help? I mean, they are helpful. They're nice. We can do some order types that weren't possible there previously. We get best execution price. We can kind of fire and forget a little bit, but has it had a fundamental kind of change to what we do? I don't think so, and I think we would have been able to perform just as well. But again, we're not institutions, so I do think they're going to be of great benefit to institutional money.
And so next one, at what point should people care enough to start investing in crypto? So
can I start with that one? I could start with that one if you want.
What do you say?
I could start if you want with that one. I think now, so I don't want to seem like I'm a bear on the industry. I think now is the perfect time to start investing in these things. So we did a study. I didn't do the study, but I just saw a recent study that was done that if you take 1% of your portfolio and you had put it in Bitcoin over the last 5 years, the risk rewards of that 1% allocation would have helped your portfolio by some number. I don't remember what it was. Even in scenarios where Bitcoin goes to zero, through the bear market, through the winter, or through the bull market, right? So you're going to increase your portfolio performance and lower your volatility through this, but small, right? I'm not saying 50%. I think 1-2% sleeves is where general investors should start caring about crypto.
I think the sad thing is, because you say people, I'm going to interpret that as retail. What has to happen? We need another ridiculous boom, and then it's on the news everywhere, and people are getting FOMO. I don't think that's healthy or good for the industry, but I think that's the type of event that will pique people's interest. I think in 2017, we all know it was the ICO boom. I think we're seeing some nice innovation around decentralized autonomous organizations. They are probably going to be attractive to retail investors. So next year, I'm predicting we'll have a DAO boom, and people will be investing in, kind of like foundation DAOs and charity DAOs. But it will be, the DAOs will be organized and arranged around things that people really care about, whether that's climate change or whatever. And I think DAOs might be the next thing to drive the next retail boom, if it's not institutions coming in first.
Thanks. So do we believe the asset management industry has a problem with how it's communicating crypto investment opportunities to retail clients?
You have to be careful with that one. That's a bit of a tricky question. Well, from what we're seeing, the asset management industry, so crypto asset managers are not necessarily marketing to retail clients. Okay, they're marketing to institutional investors. Now, the nice thing with crypto is that we've seen the rollout of several platforms that are essentially lowering the barrier to entry to alternative investment opportunities for retail clients as well. So maybe, I don't know if that's what the question is pointing towards, but...
So, yeah, basically it's difficult to market a crypto fund to retail client because of the regulatory restriction very often. So I guess maybe for Dev, the ETP will probably help in that direction.
Well, I think the issue is this, right? It's an education problem, and the difficulty with this entire space is that as you start educating, you almost immediately drop very deep into the weeds, and it gets very confusing very quickly, right? So, and I think that's the if you would call it a problem with communicating crypto investment opportunities, right? What you need to do is express, and that's why I was talking about this 1 or 2% portfolio allocation for investors, just general investors, right? You need to give them, it's not enough just to tell them what it is and then to get deep into the technicals of, how blockchain works and everything like that. You want to give them a, way to play in a way that's not like throw 50% of your portfolio in there and you're going to increase your leverage and blah, 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 right? You want to educate them on what that will potentially do to their portfolio, those small sleeves, right? That's how you start an education process. Then when they're owners, they've expanded the base, there's more liquidity, there's lower volatility generally, and it becomes safer for them to increase that. So I think it's all about education and keeping it a little bit out of the weeds if we can.
I totally agree. As a victim of, someone who tries to explain too much about crypto, there's incentive mechanisms and you're aligning the stakeholders with the suppliers of the network. And these guys are just like, we're talking a whole new lexicon here. And, it's as if you've got to go through a door and then you get it, but you're always looking back at the other people. And like, until they've bridged these gap about what these assets actually are, they're like nothing that's ever existed before. And the best way to do it is just say, look, you're going to make money if you put 1% in here, because that's all people really care about when they're investing.
I'd be careful about saying you're going to make money, but
okay,
other than that, we agree.
Okay, well, thanks everyone.
Cool, thank you.
Thank you.